Hi, everyone, and welcome back to 1 Month in 1 Minute. So, July was one of those months where, from a high level, the market looked pretty quiet. The S&P 500 finished the month roughly flat. The Dow held up fairly well, but underneath the surface, there was actually a lot going on, especially in the areas of technology, AI, interest rates, and oil. And that's really the important part. The Nasdaq was weaker in July, and a big reason was that some of the AI and technology names started to cool off. Now, keep in mind, that doesn't mean AI is over. It doesn't mean that technology is broken. It just means that when a part of the market has had a really strong run, investors eventually start asking, okay, how much of this is real earnings and how much of this is excitement, right? That's where concentration risk comes in. Concentration risk simply means too much of your money depends on one area of the market doing well. So if your portfolio is heavily tied to large technology companies, a pullback in that one area can feel bigger than the overall market headlines suggest. The other big story in July was the Federal Reserve. The Fed met at the end of the month and decided to hold interest rates steady, again keeping those rates in that 3.5 to 3.75% range. But the important piece was that the vote was not unanimous. 3 Fed officials actually wanted to raise rates. So what does that mean? It tells us inflation is still a concern. The Fed is not ready to say we're done, and the market is still trying to figure out whether rates stay higher for longer, whether inflation keeps cooling, or whether we could see more pressure ahead. And then you add oil into the mix. Middle East tensions picked up back in July, and oil prices moved higher. That matters because energy prices don't stay isolated. They can flow through to gas prices, shipping costs, travel, groceries, and all these different pieces of the economy that people actually feel. Bond yields also moved higher, especially longer-term yields, and that can put pressure on both stocks and bonds. Again, not because anything is necessarily broken, but because markets are constantly adjusting to new information. So the takeaway from July is pretty simple. The market may have looked calm on the surface, but it wasn't calm underneath. At the end of the day, this is why we don't want a plan that depends on one sector, one Fed decision, or one headline going perfectly. Plain and boring wins the race. Stay diversified, stay patient, and make sure your portfolio still lines up with your goals, your time frame, and your comfort with risk. And as always, if you want to talk through what this means for your plan, just reach out. Use this as a resource. That's what we're here for. Thanks for joining us. We'll see you next time.